Hi everyone, in this investment minute I want to cover how we evaluate companies. This happens to be Citigroup, Citibank as you'll probably know it as, and we're often used to looking over a period of say 10 years the price of a company, but actually shouldn't we compare what its valuations are compared to what it was historically? And this is its price earnings ratio, which is just one measure, the price of the company compared to the profits it generates, or the price of the company to the book value. In other words, if you sold all its assets, what would you get back? And you can see here it's actually at relative lows. Similar with price to book, price to sales, or price to turnover, price to cash flow, relative lows, or enterprise value, the value of the company compared to its EBITDA. It's a bit complicated. This earnings before interest, tax, depreciation, and amortization. Put another way, it's just this clever way of saying price to earnings, price to the profit. Is it overvalued? Well, again, it seems to be at 10-year lows, 10-year lows, 10-year lows, 10-year lows. You know, it looks like the company could go up a fair bit without impacting valuations. Of course, there's two sides to this equation. Earnings could fall drastically, in which case all of a sudden it doesn't look so undervalued. Anyway, it's one of the things that I like to look at. It's an important way of evaluating a company, not just where its price is today in relation to where it was 10 years ago, but what's its valuation in relation to where it was as well.